Good to see everyone. My name is Amanda Graham, and I'm the Academic Director at the Irving Institute for Energy and Society at Dartmouth College, and it is my pleasure to welcome you to this week's online DEC Energy Lunch Seminar Series. As usual, in this new world, we are not providing pizza lunch, so hope you're feeding yourselves some other way today. But we are really delighted to be able to bring to you today one of our alumni who works in the energy sector to share his view from his vantage point. So I'm really pleased to introduce Darren Peers. Darren graduated from Dartmouth in '96 with an economics degree and then from TUC in '01. He is currently the senior vice president at the Capital Group. He's been serving as an energy investment analyst for 23 years at the Capital Group, and then before that at NWQ Investment Management Company, Putnam Investments as well. And so Darren is going to speak today on near-term dislocations and longer-term challenges of energy procurement. His specialty area is in oil and gas refining and marketing and investment, but he really sees that within the bigger picture of the energy transitions that we are working to make toward a more sustainable energy future. And so I'm excited to hear his vantage point from working in the industry and being in touch with a wide range of CEOs in this space. So with that, Darren, let me hand it over to you. Darren's going to speak for about 30 minutes or so. Please feel free to send your questions in via chat to Stephanie, and I will help to moderate the Q&A for our discussion. So Darren, please take it away.
All right, thanks so much, Amanda. I am going to share my screen here and bring up my slides. And that'll just take me a quick minute and then we'll get going. A couple clicks. Okay. Everyone see that okay? That's a single slide view? Excellent. All right, well, real pleasure to be here. I am really excited. I love the energy industry. It's so intellectually challenging. So anytime I get a chance to talk about it, I generally enjoy that quite a bit. Let me start by just telling you a little bit about the Capital Group first, and many of you may not have heard of the Capital Group. What you may have heard of is our fund brands, which is the American funds. We were founded as a firm in 1931, so we have a really long, rich history. We're a private partnership. We're actually the largest equity mutual fund company in North America. We manage somewhere around 1.9 trillion in assets. We have offices around the world, which gives us a really broad reach and insights into the global economy, which is a real advantage for us. Probably two of the things that I'm most proud of. First is that we manage the savings accounts for nearly 50 million Americans with an average account size of about $50,000. So we're truly doing the savings work for hardworking Americans across our country, and that's something I'm really proud of. The other thing that I think really differentiates us is that our investment professionals are compensated on a 1, 3, 5, and 8-year basis, with the highest weighting given to that 8-year time frame. And so there's a lot of investors that say they're long-term oriented, but they're compensated on a 1-year basis. We're truly compensated on a basis that we think aligns us with our clients, and it also aligns us with often with the companies that we're investing in, and that's a real differentiator. I also wanted just to give you a little bit more background on myself. So as Amanda said, I've been an investor for over 20 years. Time flies. And I've done a lot of different types of investing. Predominantly today, my bread and butter is oil and gas companies, exploration and production companies, and oil and gas as a commodity. But I've invested in public and private companies, and also in commodities futures, and across the energy spectrum over the course of my career. And the work I do today actually really necessitates that I do stay focused on transitions and how we're going to procure energy over the long term. A couple other things about the type of work I do. I do a lot of collaborative work with my colleagues, and we travel around the world. So I get the opportunity to travel to China and South Korea each year. We do electric vehicle research, battery research. We do that in collaboration with our auto analysts. We meet with companies and policymakers. For instance, government officials from the NDRC in China that sets really environmental policy for the country. I get to travel to the Middle East each year, to Saudi Arabia. I meet with various ministers to understand their longer term challenges. And so I'm very fortunate to have, I think, a pretty broad view of the way we procure energy and how that's potentially changing. It's really intellectually stimulating work. The last thing is I put a quote down here, and it's a quote from a former Tuck professor, Professor Shank. There's nothing commodity about a commodity business. If you think otherwise, you get what you deserve. As I got into this business, that stuck with me more and more. I cover oil and gas companies, and on the surface, it looks like they do much the same thing. And some of these companies working in the same fields, trying to get the same results. It's amazing the difference in profitability that you see in companies really trying to execute the same strategy. So that's just for students looking to get into this industry. That's a word to the wise, I suppose. Okay, let me move on. What I'm going to do is I'm going to spend the first part of this talk just on some short-term dynamics, what is happening today, because it's really unprecedented. And then I'm going to transition a little bit to some longer-term thoughts that I think are actually perhaps more interesting, but it's hard to get away from what's going on right now, because like I said, it is truly unprecedented in my career. And what this slide is, well, the COVID pandemic, as you're all aware, it's brought the world economy to a virtual standstill, or at least parts of the world economy. And one of the clearest ways to see that is in energy demand, and this is oil demand. And this is a chart going back in time. You can see what happened in the global financial crisis. And from peak to trough, we lost about 2.5 million barrels a day of demand, which was one of the worst demand downturns that I had ever seen. And I started my career in the Asian financial crisis, so I've seen a few. And I actually grew up in Calgary, Alberta, so I lived through the oil price crash in the 80s as well. Today, we're estimating that in the month of April, global demand is currently down by 25 million barrels a day. I mean, that is just a level that I couldn't even fathom before this happened. And then I've got a question mark beyond today. And the reason is I don't think really any of us know how quickly the economies will recover, how long it'll take for people to start flying again, how this pandemic may change work habits, commuting patterns, etc. So a lot of uncertainty out there. And then obviously with this kind of demand downfall, it's put extreme pressure on commodity prices. The graph on the left is the oil futures curve. In yellow was where it was a year ago. So the spot price is the near, the $60 price, and then going out over the future, what the financial markets were pricing for crude in out years. Today, in red, you see that the spot price is in the teens, and it's been very volatile, and the entire curve has shifted down. So dramatic impact on price. And then the graph on the right shows refining margins, or more specifically what we call a crack spread. So what it is, it's the difference in price between what refiners sell, which is gasoline and diesel principally, and their input costs, which is crude oil. And so in a weak demand environment, what they sell is not getting as strong a price, and margins are down, which you can see by the red line there, and how much those have fallen to almost zero, essentially. So really tough economic environment. These graphs are storage, crude storage at the top, and then gasoline storage and distillate storage, or stocks as we refer to them in the financial markets. And you can see in the red lines for all of them that pronounced turn upwards as we start to fill storage, both here in the US, and worldwide. And just as an aside, some of you may have seen that oil prices went negative 2 weeks ago. And I'll share a little anecdote about how storage plays into that. When financial people like myself trade futures markets, oftentimes we're trading what is called the front month futures contract. So 2 weeks ago, people were trading for May delivery of oil. And 2 weeks ago, that contract was about to expire on the Wednesday. And financial people like myself, we can't physically take delivery of oil if we buy a contract. So what we have to do before the contract ends or expires is we have to unwind it. And an interesting phenomenon last Monday was that there was a lot of commercial players who actually can take physical delivery that recognize that the delivery point for the NYMEX futures contract is Cushing, Oklahoma, and storage was projected to fill up in May at the current rate. And so that set in on that Monday a panic that all the financial players had to unwind, and there was literally no buyers. And that is what happens when you have a short squeeze or a panic. Prices can go to very extreme levels. So we hit negative 40. This is just this slide here is just another look at inventory builds. It's plotted against normal builds and draws. That's the blue bars that you see. And the last 4 or 5, you can see the dramatic downturn in crude stocks or inventories building in the United States. So again, just another look at a really unprecedented time. Okay, so the market's obviously sending a huge signal to producers of oil that we have too much supply. And I get to talk to a lot of oil and gas CEOs, and these days it's been on almost a daily basis, and it's quite remarkable. I guess the climate out there is anything from outright panic if a company is in financial distress to maybe just despondent and we need to hunker down and get through this. But today there's really no oil well or gas well that can be drilled in North America economically. And so what this graph is, it's the rig count, oil rigs drilling oil wells, and there's only so quick that you can release these rigs, so it's plummeting. And actually, this is already out of date. It says 378 rigs. As of Friday, we're at 325 rigs, and that's going down precipitously. So it's a sign of how bad the economics are and that the industry activity levels are imploding. Okay, one of the things that I get to do that's kind of interesting, intellectually interesting, and I guess I find it fun, is I get to make projections. And this is one of my projections. The gray line that you see here is the number of wells that gets completed every month. And pre-lockdown up until March, we're completing about 1,070 wells, oil wells, every month in the United States. The orange line is actual oil production in...
Darren, quick question.
Yes.
For those of us who aren't as familiar with the oil and gas industry, could you just explain briefly what it means to complete a well? I mean, does that mean the well is empty? Does that mean when you put a cap on it? What does that mean?
Yeah, when you drill the well, you actually have to do, you fracture the well and then you get it ready to flow, and you tie it in with infrastructure, with pipelines, so that you turn it to sales. So I just, the quick way of saying that is you complete the well. So it's after it's drilled, it's ready to go, you actually turn it to sales. So those are essentially the wells turned to sales. Thanks, Amanda. And so, as I was saying, the orange line there is actual oil and gas production for the lower 48 states in the United States. So moved just over 10 million barrels a day. And then the blue line is my model. So I track that with my forecast, with the actual completions, and then I forecast with my completions and my model of how much every well produces. Now, one thing some people may not realize is that oil and gas wells, individual wells, decline over time. And that's because they deplete and they lose pressure. And so to keep production flat, you actually have to keep drilling more wells to replace those declines. And so off of this projection here, if I believe that, and have some evidence now, that completions, wells turned to sales, are plummeting. I'm projecting they go down to somewhere in the level of 300, and then we will see where they go. But if they start to rebound somewhat to the level of like 700 that I've projected, which may be optimistic, to be honest, I'm projecting that the US will lose 2 million barrels of supply by year end. A huge number of amount of supply that will be lost by year end. And so, you know, it's just another way of showing, you know, classic commodity markets that when price is low, there's a supply response. And this is perhaps the best example of that. Let me move to my, my last near-term slide. And this is just a chart of OPEC production in October of 18, March of 20, and then cuts that they've announced. So some of you may recall that a couple months ago, OPEC Plus, the plus is for essentially Russia, came together in an emergency meeting. And the Saudis in particular believed that this was going to be a severe demand contraction and that severe cuts were going to be needed to try and hold supply and demand in balance. I'm just going to pause for a minute. If you're not on mute, could you please go on mute so that we don't get any feedback? Thanks. Just check to see if you're on mute or not, and please go on mute if you can. Okay, so this was 2 months ago. There was an emergency OPEC meeting. The Saudis put forth a proposal. They actually didn't put forth any options with that proposal. And the Russians, and I've actually spoken a couple times to one member of the Russian delegate, the Russians, they didn't like that too much. And so they balked and they walked away. And then the Saudis didn't like that. So they said, well, then we're going to flood the market with oil. All bets are off. All cuts are off. All of OPEC should feel free to produce unlimited amounts of oil, which actually hit the market in April. And on top of the demand shock, led to a supply shock as well. And then, and I could regale you with some other OPEC stories, but for the sake of time, I'll let that pass. And if anyone wants to bring it up in Q&A, we can talk about that. But anyway, so we went into this kind of all-out price war. And finally, you know, pressure was brought to bear. There's a tremendous amount of pain around the world, both actually even with the Saudis and the Russians. Both would be running and are running extreme fiscal deficits. So it's financially very tough on them. It's even tougher on countries like Iraq, Nigeria, Iran. And so, and with some US pressure, OPEC Plus came back to the table and negotiated a new level of cuts. And so this table sets that forth. One thing I'll note about this is OPEC Plus has agreed to almost 10 million barrels a day of cuts. That actually isn't enough to balance supply and demand in the near term. But what it does is it hopefully sets the stage that as demand starts to recover somewhat, that the market can come back into balance. We can draw down inventories back to normal levels and get back to a functional oil price that doesn't cause significant dislocations. And I guess what I mean by dislocations is this type of oil price is actually so severe that it actually has the potential to create some really uncomfortable situations in countries like Iraq, Iran, and create social unrest, let alone what it does to the US industry. So it is pretty painful. I'll give you one more colorful anecdote that I mentioned 2 weeks ago on Monday. Oil prices went to negative 40. I was on a call the following day on Tuesday with a few investors in the OPEC Secretary General, Mohammed Barkindo from Nigeria. And it was basically an opportunity for him to maybe understand an investor's point of view, a US investor's point of view, but he opened with some remarks and he said, we met again today and it was beyond us. And I'm not sure I've ever seen that level of despondence from somebody within OPEC. So that was quite striking. So I guess for the short-term part of this talk, I'll just end on this. That the energy markets, they are in chaos today. Storage is filling, supply is getting shut in, and some of that supply shut in will be permanent. There's a lot of financial distress in the markets today. Some companies will survive. There will be others that won't. That is what happens in commodity markets, and albeit this is probably the worst downturn I have ever seen. The longer this goes on, the more severe the ramifications will be, even to the point of potentially destabilizing some countries. Hopefully that doesn't happen. But the survivors in the industry will get through this. The industry will go on, and like I said, commodity markets are volatile, and even though this is extreme, this is what happens. I want to spend the last number of slides just on something maybe it's a little more optimistic. I don't know. It can't be more pessimistic than what I've just described, perhaps. But certainly things that I think are even more important to society, and those are the medium longer term challenges. What this slide shows is global energy use by primary fuel, and I think sometimes people forget that over the next 20 years, let's call it by 2040, the world's likely to have 2 billion more people. And if we continue to consume energy the way we have over the past, if current trends hold, we'll consume nearly 40% more energy. And the biggest challenge I think we face is the tension of providing affordable energy to people and doing that in an environmentally conscious way. Here in the US and in Europe in particular, these are areas of really great relative wealth. And we're keenly aware in these countries of the environmental challenges. But I'd also note that in other countries around the world, like in India, in Africa, and even still in China, providing affordable energy to help lift people out of poverty it's a paramount concern. And so that tension between cheap energy and environmentally responsible energy is a challenge. This next slide, it shows that increasingly this will be a challenge for India and China. By 2040, India is likely to consume almost as much energy as the United States, and China will consume over double the amount of energy of the United States. And any energy policy and environmental policy needs to be cognizant of that fact, that it has to be inclusive of those countries and the challenges that they face. I'll come back to that, to some of those global challenges in just a minute, but I wanted to bring it back home to something that I spend a lot of time on, because I'm predominantly investing in oil and gas companies, and this is the area I know best. Here's a couple of charts that are just a reminder again. The one on the left is crude oil, and I think some of you probably are aware that oil production in the US peaked originally in 1970 and then went into a long, slow decline and bottomed about a decade ago. And natural gas actually did something similar, although it started to increase again a little bit sooner. And I often talk to people at Capital Group about oil and gas being in this tension between geological degradation and technology. Okay, so the oil, we're constantly fighting getting oil and natural gas out of worse rock, worse quality rock, less permeable rock. Okay, but we're using technology to overcome that and get it out more efficiently. And it was technology that really led to this resurgence of US oil production and gas production. It was technology of hydraulic fracturing, learning to split that rock open in an efficient way, and horizontal drilling, exposing more of the wellbore to reservoir rock. And then there was a whole host of other somewhat less impactful technologies that help us characterize the reservoir. amazing technologies. And so we're actually able to go into this tight, impermeable, what you've heard of as shale rock, although it's not all perfect shale, but shale rock, and get oil out of that rock. And it led to an amazing resurgence. And the implications of that for our country are really, were quite important. Important to foreign policy, how we deal with the Middle East, important to our balance of payments, important to consumers that actually got cheaper energy. And that shouldn't be overlooked. So that's some of the good news. Here's some less good news. I have some really interesting software that allows me to look at every well that's been drilled in North America, and I can parse that in different ways. What I've done here is I put up some charts of different basins or formations around North America, the most impactful in the United States. And if I took I'll just explain to you the top left chart, the Midland Basin chart. What this is the average well, let's start with the light blue line. It's the average well drilled in 2013, and it's a rate versus cumulative production plot. Okay, so it's the rate is on the y-axis, the cumulative production is on the x-axis. So more productive wells, you'll see that line move up the x-axis and probably up the y too. So in 2013 in the Midland Basin, you see that's that bottom light blue line. In 2014, it got better. We got more out of the wells as we learned to fracture them more efficiently. 2015, better still, okay? That's the dark blue line. And then we get into the orange and red lines, which is 17, 18, 19, and no improvement. And in fact, I did a study back in September of every basin, every formation within that basin, and then I parsed it down. It's actually probably worse than that. That it's actually starting to degrade by formation, and that's that geological degradation. Okay, so we've got over the last 5, 6, 7 years, the U.S. wells got more than two times more productive, and that led to that huge growth we saw. And now that's starting to wane, and it's actually starting to reverse. Okay, and it's a reminder to me that this great unlocking of shale is actually, in the longer term scheme of things, and the big scheme of things, is relatively a short-term phenomenon, and you're starting to see costs go up, absent the COVID pandemic, which will kind of obfuscate that for potentially a year or two. So that's an important thing to keep in mind, that cheap oil maybe doesn't last, and the benefits that this country has enjoyed over the last 5, 6, 7, 8 years may not last either, without at least another step change in technology. This is the same charts for just 2 natural gas formations, the Marcellus, which is huge, and the Haynesville, which is another one in Texas, South Texas area. The good news on gas actually is, even though productivity is also stalled out with gas is a smaller molecule, and it's way more abundant in North America, and it's a lot cheaper to produce. And so you're probably not going to see an increase in the marginal cost of gas nearly the same that you will in oil over the next 10, maybe even 20 years. We have quite a bit of natural gas, and that's actually provides us, especially in the electricity chain, a lot of good benefits as we're transitioning to renewables. I wanted to show you another slide since we're on gas, and walk through really something that was really impactful from an environmental standpoint. So hydraulic fracturing really started to change the cost curve of natural gas as we went into the Marcellus formation, a huge source of natural gas, and proved up a tremendous amount. And that really started to show itself in 2008 and beyond. And it was very deflationary for gas. So if you look at a chart of gas prices, and I probably should have put one in here, it was very deflationary from 2009 till the present. Back in the previous decade, the marginal cost of producing gas was increasing pretty dramatically and was running about $7, $8, $9 an MCF. Today, the marginal cost of gas is about $2.75, so a dramatic decrease. And what that did is it allowed gas to displace coal in the electricity chain. And because of that, one of the great benefits was that we reduced our carbon emissions pretty dramatically. And you know, that had a huge benefit. That has a huge environmental benefit. It has a huge benefit actually economically as well. And the point though that I want to make with this is that this was primarily an economically driven construct and not a policy driven construct. So yes, there were a lot of environmental policies directed at coal that made it more difficult for coal, tried to clean up some coal plants, but and that was helpful for sure. But if it wasn't for cheap gas, I don't think we would have seen this same level of improvement. This slide here, I wanted to underscore that in a little bit more detail. There is a reason that China, India, and South Africa, to pick 3 countries, use so much coal. They have a lot of cheap and domestic sources of coal, and it's the cheapest way to power their economy. China, in particular, is not endowed with a lot of cheap gas, similar for India, and so they lean on coal. You know, I mentioned at the start that I get to meet with some policy people in China, and I'm always actually very impressed with how astute they are about the environment, and that they are trying to find a balance between being very environmentally responsible, but also economically sensitive. And I think for anyone who's thinking of going down the road of being involved in energy policy, that's just an important realization that many of these countries have domestic sources of energy, and that's what they lean on. And that's a tough thing to get away from. Last slide is the IEA's estimate for future energy use, and they have 3 different policies. A current policy scenario, which is kind of like status quo, we just keep going on the way we are, which is not good. Their new policy scenario, which contemplates some changes, some additional environmental constraints, if you will, and then a sustainable development scenario. And you know, I'll share with you a story, actually, that each year I host an energy symposium in my hometown of Calgary. And this year, unfortunately, it was canceled because they canceled the Calgary Stampede, which says something about the pandemic. But this year, I had a really interesting lineup of speakers. I had a number of people that were going to speak about carbon mitigation technologies, things like direct air capture of CO2 and sequestration of CO2, catalytic sequestration of CO2 with limestone and salt water, geoengineering, different agriculture initiatives. And you know, I look at this slide and I think a number of things. I think the current policy scenario, that's not going to work for our society. It doesn't look realistic to me. The emissions go too high. It's going to force a crisis. I also would say that the sustainable development scenario doesn't look realistic to me, because it's hard for me to contemplate a world with 2 billion more people and energy use is flat. And so I want to go back to what I led with, which this is a huge challenge to meet growing, I think, energy needs for society, and do that cost effectively, but also environmentally efficiently. And so, you know, going back to my story about carbon mitigation, and this was principally focused on the oil industry, I think we're going to have to think really broadly and about how we mitigate carbon, how we control emissions, and it's going to take more than even just a transition to alternative sources of energy. I also think it's going to take some more robust mitigation. Certainly not an easy challenge, I tend to be an optimist. I am an optimist. I think human ingenuity is amazing, but I think it also is going to take the right policy incentives and much more political will than we've seen to date. That is a lot. I'm going to pause there. Hopefully, yeah, I stayed reasonably on time, and I would love to take your questions.
Darren, thank you so much for that. That was an incredibly cogent, thoughtful review of where we are now and where you're looking forward from your standpoint as an energy investor focused on oil and gas. I want to remind folks to keep sending your questions over the chat. But I want to quickly take a moderator's prerogative and pose one myself. Your last couple of slides highlighted data from the IEA, the International Energy Agency, and I don't know if you saw their global energy review that they published last week that was really looking at the impacts of COVID on the energy industry. And there's a lot of interesting projections, potential projections or trends. Obviously, we don't know what the future holds, but depending on how things are shaking out, there's some really interesting data there. But I just wanted to highlight a quote from Fatih Birol, who's the executive director of IEA. The energy industry that emerges from this crisis will be significantly different from the one that came before. I wonder if you could comment a little bit on that from your perspective, both in terms of oil and gas, but also more broadly about the energy sector and the energy industry that, where we get our energy from. How would you, if you were in a conversation with Fatih, how would you respond to his, to that observation?
I think it's too soon to tell, to be honest. There's so many moving parts. I could construct a scenario where by the end of this year, global economies are recovering, probably still recessionary, but functional. And commodity prices have improved somewhat, probably not all, but life starts to feel a bit more normal again. A lot of moving parts in how that plays out. If that were the case, there will be impacts, but maybe not as far-reaching as Mr. Birol's statement. There will be impacts, and the easiest ones are that, I'll start with my area of expertise. In oil and gas, especially in North America, it has been an abysmal decade of return on capital, of profitability for those companies. And capital has been removed from the industry generally. Providers of capital, like myself, private equity, and others are not providing capital. So the industry is going to be capital scarce, and this pandemic, this downturn is exacerbating that. So that impact, I actually think, is going to be far-reaching. That's probably the most tangible one. And when you look around the world, the final investment decisions on major projects has come to a standstill, and it was already at a pretty low level. U.S. shale is going to be in precipitous decline and won't turn on a dime and rebound. I actually think we run the risk of a fairly significant commodity price spike in oil in a reasonable demand recovery scenario, which is what it is. That volatility is tough on consumers. Strangely, people have various different views on this. And I'll dovetail just for a second. I've heard some people say that low oil prices may get in the way of transitioning, like electric vehicles. I kind of doubt that, actually. I think there's a lot I can talk about. I do think if we run a serious price spike on the other side of this, that actually could enhance a transition. So those would be a couple that I think you'd say with a little bit more certainty. Like the lack of investment into energy today is really pronounced.
Thank you. That's a great global response to my question. That's really interesting. I've got a follow-on to that asks for a little bit more specificity. So John Jeffers asks, in terms of energy transition and rates of penetration by wind, solar, geothermal, hydro, et cetera, do you think that the current price environment is likely to A, delay movement away from fossil fuels because fossil fuels are relatively cheaper, or B, perhaps encourage the movement away from fossil fuels in part to get away from fuel pricing volatility and uncertainty versus the non-fuel dependent sources. So basically, which way do you think that we're going to go in terms of the possible penetration of renewables, for or against? And I think it also to do with that project size question, right? And investment question, but
Yeah.
your thoughts.
Okay, a lot in that. Where should I start? Let me start with transportation fuels. Let's start with oil. That's the one I spend the most time on and I find fascinating. I mentioned I do a lot of battery work, a lot of electric vehicle work, fuel cell work, and so on. One thing that always strikes me, I could go back 10 years. Actually, my wife's listening right now. Her dad worked on fuel cells like 30 years ago, and it always strikes me in my conversations over the last decade plus, battery technology, well, it has gotten a lot better and is moving down the cost curve, and I think we do have a reasonable line of sight to getting to a parity with an internal combustion engine, and certainly now there's product on the road today that competes, but it's not cheaper. That's just with the existing lithium ion battery, it's just a very difficult process to actually continue to work those costs down. My personal view is that if we're truly going to get below the internal combustion engine, you're probably going to need a whole different battery chemistry, or we're going to have to improve the solid state battery technology and get that down the capital cost curve. So that transition in electric vehicles is just a long, slow transition. It certainly looks more promising now for more mass acceptance than ever. Obviously, like, people are driving Teslas and driving electric vehicles, but not en masse because it's not that cheap. But what could really move the needle along with that is autonomous. And because autonomous just totally sets the economics on its head. The average person drives a car 12,000 miles a year, okay? And that 12,000 miles, the thing with an electric car is it has a really low operating cost, but a really high capital cost, okay? With an autonomous vehicle, that vehicle will drive around and it'll do triple the amount, quadruple the amount of miles. And all of a sudden the you can get over that high capital cost really quickly. And it makes a lot more sense than in an autonomous application like robo-taxis to do that through electrification. So that's something to pay attention to. So, I think those are actually, those phenomenons are somewhat independent of the commodity volatility. But I just couldn't help but share those, that I think technology is moving along, and those are the things to watch for: battery costs and then autonomous. That's hugely interesting. On the electricity chain, wind and solar have great economic propositions and are being widely deployed in areas where it makes sense. And I think that will continue, and they'll have a huge ramp. And then there's also the issue that they are intermittent. So, I mean, the U.S. is very fortunate that we have great wind resource, great solar resource, and we have natural gas that can supplement and help with that. Not every area around the world is quite as well endowed, or nearly as well endowed. So again, there are economic challenges. And I will say, if we ever really do bring battery costs down, and in some applications, batteries next to wind and solar make great sense, and in other mass applications, that doesn't quite get to economic parity. But if you bring battery costs down, it unlocks a massive world for wind and solar. So I actually probably view all of those transitions through a lens of just the technology development more than the commodity price volatility.
Awesome, thank you so much. That's again, lots of complexity, but nicely tied up. Darla Bruno asks, in my research, the shale wells typically only produce for between 3 and 8 years, with a mode of about 4. So mean average mode, right? Mean median mode. And that's why we keep drilling more holes. Couple that with all the gas lost through leaks and flaring off and factoring in climate change. Her statement is, this doesn't sound like a winning investment, right? So I think the question is, tell us your thoughts on why it is or is not a winning investment given those concerns or caveats.
Okay, I'm going to address flaring and leaks right up front. A topic near and dear to my heart. One of the great things about Capital Group is we manage a lot of money, which gives us some influence in the markets and with the companies we invest in. None of the companies, so I can think of one company that produces, and I'm not going to name it in this forum, but one company that produces in the Bakken that is flaring up to, or at least were up to 50% of the natural gas that's associated with the wells that they produce. Absolute waste, environmentally disastrous. We'll never see a nickel from Capital Group, as long as, probably ever, given that they were willing to do that. But they know quite strongly that they are off our investment list. We invest in companies that have gone to essentially zero flaring, monitor their pipeline and gathering pipeline for leaks, have very sophisticated monitoring techniques. It is top of mind today that all of our investments are adhering to top decile environmental standards when it comes to flaring and leaks. So yes, there is a lot of waste in this industry. It doesn't need to be that way, and it's shameful. So that's my 2 cents there. On the length of an oil and gas well, I also look at, like I said, a lot of different wells, parse that different ways. So these wells start off really flush, and then they go into hyperbolic decline, and then exponential decline, and some will last 30 years. Although it's interesting, the questioner said 4 to 8 years. I'm always, I'm often having this conversation with the executives that I interact with. Like, your type curve, the model of your well, is often overly optimistic that you cut these wells off sooner and they don't go quite as long, and you should take that into account, and good companies do. From the data I look at on my companies, so that's the profile. Most of your net present value is in the first 3 years. You actually, if you're going to have an economic company, need to get the entire cost of drilling back in about 2.5 years. And then if they're managed properly, they should go into an exponential decline that is anywhere from 7 to 12% per year. And those can last actually quite a long time if they're managed properly. So that's kind of with most of the companies that I deal with. I will tell you, each formation is a little different. The Eagleford, for instance, is a true shale. It's really tight rock, very impermeable. Those would be at the shorter end of the spectrum, and I see a decline that's a lot steeper. And then because of operating costs, they do tend to cut them off at 8 to 10 years, is my experience.
Thank you very much. Andrew Alley asks, are your clients reacting to this oil downturn with a desire to shift their portfolios away from fossil investments? What effect is this having in the short term, and what happens if more folks start thinking this way?
Yeah, so as I mentioned, most of our clients are putting their savings into one of our mutual funds. And so they don't, our clients generally aren't making active sector allocations. So I wouldn't see it there. But I do see, some university endowments are shifting their investments away from fossil fuels. And I would say each to their own on that. I live in California. I have a lot of coffee table type of conversations about what it's like to be an oil and gas investor. I'll just say this. The companies I invest in, I think actually are are very environmentally sensitive and prudent. And when you're producing oil, you can do that in an environmentally appropriate manner. The amount of CO2 that's produced when you're producing at the upstream is about 50 kilograms per barrel. The amount that is produced, CO2 that's produced when you burn it in your car, is about 500 kilograms per barrel, 450 to 500 kilograms per barrel. Okay. When I hear people, so this is my view, when I hear people divesting of oil companies, that's all fine. But your first line of defense, or your first action actually to reduce CO2, in my opinion, is think about ways that you can consume less oil. Because it's actually the consumer that's the problem. And as consumers, we all want cheap ways of getting around and mobility and energy. But we have to be really thoughtful about that. So that's just, that's my 2 cents that, think of how much CO2 emissions are burned when we as individuals consume energy.
Thank you for that. I mean, I think that that 50 versus 500 kilograms per barrel, that is an interesting data point on that front. And I think we're starting to wrap up. Folks, if you have any last questions, please send them. We've got about 7 minutes left. So I'm going to pose one here from Chris Price. How can the upfront capital costs of nuclear be factored in with the tendency of cheapest domestic supply, especially compared with baseload coal? From your standpoint, from your perspective, is nuclear adoption policy driven or economically driven? We haven't spoken at all about nuclear yet today.
Yes. I love that question. Nuclear, especially in the United States, is a bit sad to me. We have had all this nuclear technology, and it's one of the clean. Okay, so I'm going to say something that might irk a few people, but nuclear is clean energy, no carbon emissions, and you have to figure out how to dispose of the waste, which is a huge political football, if you will. But nuclear, is really quite remarkable. And the challenge with nuclear is there's been a couple of obviously very high-profile incidents, but the safety record of nuclear is way better than the number of deaths through coal accidents. So the question really is a really astute one. The problem with nuclear is the capital cost is so immense that it doesn't look economic today, okay? But why are the Chinese building so much nuclear? The reason the Chinese are building nuclear is it's a little bit different economic model. They know if they keep consuming hydrocarbons or energy broadly at the rate that they're consuming, that they'll put upward pressure on energy prices, on hydrocarbon prices, on coal prices. So maybe when you're running your nuclear economics, it shouldn't be against everything at a flat cost structure. It should be, in the Chinese point of view, it's actually, if we don't build nuclear, all our other prices are inflating. And the interesting thing about nuclear is it's incredibly energy efficient. A little bit of uranium, produces a massive amount of energy. And so if you kind of start with that construct and say, what's best for society? Okay, that has an interesting dynamic, but it's a difficult one for private enterprise to solve because the capital costs are so high, it's not economic today, and it's also a difficult one in this country politically. And it's a bit sad because it actually, in my opinion, should be part of the long-term solution.
Thank you. Here's a good closing question as we work towards wrap up from Elizabeth Wilson. What flip in conventional wisdom might you see in that could change some of the future projections for fossil fuels in the future? So we talked about long-term trends, right? The difference between technology evolution and commodity price changes. But do you think that do you anticipate anything that that may make our conventional wisdom look different?
Yeah, I love that question. Thanks, Elizabeth. So this is a bit of a thought experiment, and it's really kind of a bit pie in the sky in today's environment, but I'd be a big proponent on $100 or $200 carbon tax plus credit if you can actually remove carbon from the system. And if you let industry go at that, and especially the oil and gas industry, because think of the entrepreneurial spirit and the amount of technology that these people employ. I mean, the things that they do to drill 10,000 feet into the earth with magnetic resonance imaging and the technology that they use. So if you gave them $200 a ton incentive that we're going to tax your hydrocarbons at that level, at 100, it's about $1.20 at the pump, so we could afford it. Okay, and 200 double that. You said we're going to tax your product, so we're going to hit the demand if you don't get your act together, but we'll also give you a credit if you can take it out of the system. Think of the amount of carbon mitigation schemes that would come to the fore: direct air capture, sequestration, doing things with there's things that you can do in the gas electricity chain with marrying it up with fuel cells, and I could go on and on. I just think that could actually be a complete game changer for society, but it needs the proper policy incentive, and we are nowhere close to that. I don't even hear that bandied about. I've put that in front of a few CEOs and they think I'm crazy, but that to me would be something that would totally flip everyone's thinking on their head.
Fantastic. Darren, thank you so much for spending time with us today. This was really informative and awesome. Folks, we are posting these recordings, so let folks know if they missed the show and would like to tune in. We will have it posted as soon as possible. And I think Stephanie's going to show us a slide of our upcoming events. Watch out, if you're a student, watch out for Scott Fisher tomorrow night, another Dartmouth alum, to advise on energy careers from another economics grad and TUCA grad at Dartmouth. Thursday morning, we've got the second in our series of, our third in our series of discussion panels on the open published book Earth 2020, which is looking at sort of a retrospective, looking at 50 years past and 50 years future. Thursday afternoon for students, we have energy and sustainability office hours, and then we have another Energy Sparks, Alumni Sparks conversation next week with Tom Kiernan from the American Wind Energy Association, another board member for the Earth Institute. So with all of that, thank you, Steph. With all of that, Darren, thank you so much again. This was really, really fun and informative, and I wish everyone a safe and healthy rest of your hopefully sunny day. Thanks again. Take care, everyone.
Thanks very much.
Bye-bye.